Hello everyone and welcome back to Finance for JCL. This is the show for people on the journey to financial freedom, and I'm here to help you along the way. The main focus is going to be on long-term investing. The key objective is going to be, first of all, to share the detail of that mistake that I've made, and then try and work out what the learnings are so we can help each other on our investing journeys. The first bit of detail is that I invested a lump sum into a fund in 2009. And the background is this is an accumulation fund, and most of what they do is investing in other funds. Accumulation means that rather than the dividends the company pays being paid out to you as an income, that's used within the fund to expand the size of the fund to grow your value. Now, the position here is that I was regularly investing into this fund for several years after that initial lump sum in 2009, and then after about 3 or 4 years I stopped investing into that particular fund and I just let it accumulate over time. Now, the end result is I put $1,550 into the fund as my cost of investment, and the total value upon sale was $3,355, so that's a gain of 126%. So I was feeling pretty good about this, almost a touch smug, you might say. I thought this is absolutely fantastic. I wish I'd put more into this fund. 126% growth, 11 years, that's pretty hardcore. It's really good. However, I thought this summer, as part of my journey and my learning, I'd do a bit of investigation and research into the whole of my portfolio, including this one, because this one had escaped my notice, this fund, because it'd been doing so well in comparison to quite a lot of my other holdings. Now, the research showed that perhaps in the last 10 years, just looking at the graph here, the compound annual growth rate for this fund is 8.6%. So $100 or pounds invested in 2010 would be 229 in 2020. That's pretty impressive. 8.6% is very respectable, and that's a good growth over a period of time. Now, I thought the best place to start my analysis is to compare it to my home market, because index trackers are often thought of as a very good way to get a good market return over a period of time with low costs. So the FTSE 100 over the same period, which is summer 2010 to summer 2020, that went from 100 to 127, so pretty poor in comparison, and that's a compound annual growth rate of 2.4%, which is pretty poor. So initially I thought I'd done really well here by not putting that money that went into my home market and putting it into this fund, which was much more focused on North America. I was actually getting 8.6%. And for those of you that had a look at the show that I've done around what my investing objectives are, I'm looking for a minimum growth rate of 6.66%. So we're looking at 2% above my minimum growth rate. So this is really good. But I thought I'd do a bit more digging. And what I found was once you put in the S&P 500 as another comparison, so the North American index, that's got an annual return rate compounded of 13.7% over the same period. What I could have done is, yes, I did well to avoid the 2.4 of the FTSE, but actually I could have got something much higher. So just to put it into context, the increase of putting money into the fund was 80% more than what I would have got going to the FTSE, approximately. But I could have then got another 50% or so more by putting the money into the S&P 500. My mistake there is very clear. I could have got a much higher return with the money that I put in. I'll try to translate that into some learnings. But the first bit of information is that the charge on the fund I found, which I hadn't paid attention to before, was 1.72%, whereas an S&P index fund is 0.06%. 1.72% is pretty high. So with regards to the learnings, fund performance should be regularly reviewed over a period of time, and if you've got predefined objectives that you've set for yourself, then this will assist you in that review. And don't just review against your objectives, do review against other markets and benchmarks to see how your investment is performing, as I've just done here. Secondly, do note that high fund costs can eat into returns, and index trackers are definitely a lower cost option of getting a market return. The asterisk against that, of course, is that the choice of index is very important. As we've just seen, the FTSE return over 10 years compared to the North American index is massively different. So don't just automatically invest fully into your home market. Feels like something you know is a safer place, but actually there may well be markets around that will give you much higher returns. Do consider the wide range before you invest. And as always, I should finish with the note that I'm not a financial advisor, so if you are in a position where you're questioning or you want to learn more and you're wondering where you should invest your money, you should consult a professional or do your own research. So don't just do something because you've seen a lot of this video. Don't go and put all your money in the S&P 500. That may not be a bad thing, but it may not be right for your individual circumstances. So anything you do should be considered for your own individual situation. So that's the end of the show for today. Quite a short one, but I wanted to be quite to the point. So I think the mistake that I made is clear. There are some good learnings there that I've been taking on board, and I hope they help you with your research. So all that remains for me to say is thanks for taking time out of your day to listen, and hopefully I'll see you on the next one. And if you're watching on YouTube, if you do like this kind of content, subscribe and you'll be alerted to my next video. So thank you very much, and I will see you next time.